What's up, YouTube? Okay, so today is September 17th, and it's about, I don't know what it's like, 8 o'clock or something like that. And I wanted to talk with you guys. I wanted to do something a little bit different. As you can see, I'm not in the Palisades, I'm in my bedroom right now. And I wanted to share with you guys some of my thoughts and opinions on this Federal Reserve meeting today, okay? And just when Jerome Powell comes out and makes a statement, I wanted to talk about interest rates, inflation, the unemployment rate, mortgage rates going forward, and just a number of things, right? So let's go ahead and talk about it. Yeah. So, also, I got this new computer. I've been a Windows guy for the vast majority of my life, and now I actually transferred over to this MacBook Pro that I got, and it's actually been nothing but a pleasure. But I'm still trying to figure it out, so I hope you guys can bear with me, okay? I'm shooting this on my phone, and then I got the MacBook in front of me, so just bear with me. But I'm doing my best, okay? Let's see. Let's check it out. So let's do a little review. Yeah.
Good
Here we go.
afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Yeah.
While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen.
That's right.
At the same time, inflation has risen recently and remains somewhat elevated.
So think about that in itself. The risk of unemployment rate going up has increased, and inflation has increased as well. We're in a very unusual situation that doesn't happen very often. This guy's kind of sweating it right now. But obviously, the unemployment rate going up is more important than the inflation rate going up. This is why they're going to go ahead and cut rates right now. In my personal opinion, I actually took a poll the other day and asked you guys why you think the Federal Reserve is going to be starting their interest rate cutting campaign. And the majority of you said it was the unemployment rate, and then also recession fear. So, and that's probably the right answer.
In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point.
Okay.
We also decided to continue to reduce our securities holdings.
So,
I'll-
okay, so there's two things that were said right then and there. Interest rates are going to be, or the federal funds rate is going to be going down by 25 basis points. Okay, and that's not going to really do very much because it's only 25 basis points. But it's the beginning. It's the indicator. It's the indication that the interest rate cutting campaign is underway. Okay, and that's historically speaking not very good. If you take a look at the effective federal funds rate right here, this is the federal funds rate, okay? And what you'll see is it goes up, it goes down. Interest rates go up, they go down. And if you look at these gray bars, basically each one of these gray bars represents a recession, okay? And what you will see is in just about every single recession, the federal funds rate, right before the gray actually happens, the Federal Reserve will start their interest rate cutting campaign, right? You'll see this, interest rates are high, they're 5.25. Then they say, uh-oh, something bad happened. We better start cutting rates. And then we go into recession, right? And they start lowering the hell out of rates just about every single time, right? Rates were high. They said, oh, we're in for trouble. We better start lowering rates. And then we go into recession. So when people say, I can't wait for interest rates to get cut, historically, that's not a good thing. When the Federal Reserve starts lowering the federal funds rate, it's not good. It's usually a sign or an indication that something wrong is about to happen in the economy. Something is about to break. And in my opinion, it tends to be the unemployment rate. And the reason why I say that is because if you look at the unemployment rate, here's the Federal Reserve unemployment rate, basically the same thing, right? Every one of these gray areas represents a recession, and what you tend to see right before the recession is a very low unemployment rate. Then it starts to trend in the upward direction, and then it goes vertical. Very low, down, it was at what, like 3.8, then it started ticking upward. Next thing you know, it went vertical. Next thing you know, it went from 3.8 to 6.3. Same thing. Unemployment rate was low, then it went up. So, the federal funds rate actually coming out and starting their interest rate cutting campaign is not something that we should be happy or excited about. When we look at history, right? Nobody knows what's going to happen in the future. But historically speaking, when they start cutting rates, more often than not, as you just saw, it's not because something good happened. It's because the economy is starting to slow down, and there's a very high likelihood that the unemployment rate will continue to go up from here on out. Okay, so let's go ahead and get back to this.
I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP growth policy after briefly to reduce our securities holding.
So this is another thing that I think most people tend to forget. He just said that they're going to go ahead and start reducing their securities holdings, right? So for those who don't understand, and I still don't understand fully. I'm not, a financial advisor. I'm not a macroeconomist. I don't really know, but I'm trying to wrap my head around everything. And basically, what I understand is basically these mortgage-backed securities that the Federal Reserve has been acquiring, basically from when COVID happened, 2020, up until about 2023, or whenever they started raising their rates, right? Apparently, for those who don't know what mortgage-backed securities are, basically it's the banks, when they give mortgages to people or loans to people, right? They take all of this paper and they bundle it up into a security and they sell it. They sell these mortgage-backed securities to investors, to hedge funds, pension funds, to the shadow banking, which insurance companies, in other words, and ultimately, during times of crisis, the number one buyer of these mortgage-backed securities will be the Federal Reserve. And why that's so relevant and why that's so important is because if you take a step back and realize or understand what took place during COVID, right? 2020, interest rates hit the floor. We were going through a pandemic, and the government printed trillions of dollars, right? And everyone was flush with liquidity and flush with cash. I know this to be personally, I know this is true because I know that there's people in LA County Jail applying for mortgages on their phones and getting approved, right? I personally know somebody who's got 3 bankruptcies and a foreclosure, and yet somehow, some way is still able to acquire a mortgage, right? Which is, they shouldn't even be allowed in a bank, right? But either mortgage fraud was conducted or the banks lowered their lending standards so low that anyone could get a loan and it wouldn't have even mattered, which is more than likely what happened, right? Why did the banks lower their lending standards so much? Because they knew that they give everyone a loan and we're going to bundle these into a security and we're going to sell them to the Fed. It's their problem. Who cares? Automotive loans, credit cards, mortgages, everything. Everyone gets a loan. You get a loan, you get a loan, you get a loan, everyone gets a loan. So, personally, I know somebody who's got 3 bankruptcies and a foreclosure. That person should never be able to get a mortgage again. They shouldn't even be allowed in a bank, let alone have the ability to talk about finance and money, right? So it just goes to show, if you think that subprime was bad, subprime ain't got nothing on COVID loans, okay? And now the Federal Reserve has said, we're going to stop and we're going to go ahead and reduce our securities holdings. So not only are they not buying mortgage-backed securities from the bank, they're actually going to start selling them off, right? So let's go ahead and continue with the FOMC meeting, right? Or whatever.
Thanks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak.
So that's
in our summary of economic...
That's the first time you heard it from Jerome Powell. Oftentimes you'll hear me talking about in my YouTube videos how I listen to this guy, Lance Lambert from Resi Club. He's great. He's a housing data analyst, and he basically talks about the data that Redfin, Realtor, Zillow, all of the information that they acquire and they put out there. He breaks it down in such a way that allows the average person to understand, right? You don't have to be a guy who went to Stanford and got a business degree. You can just be Cameron, the guy who drives a truck all day and listens about and learns about finance and money and how to make it, right? So basically what this guy, Lance Lambert, says from Resi Club, the housing data analyst, right? He says out of the 300 largest major metros in the United States, over 105 of them are experiencing year-over-year price declines. That alone tells you everything you need to know about the real estate market. Because if I told you back in 2022 that in 2025, 105 out of the 300 largest major metros in the United States, which could include San Francisco, Los Angeles, San Diego, Seattle, whatever. It could be just whatever it is, right? The 300 largest major metros in the United States, 105 of them are experiencing year-over-year price declines. A lot of that's happening in Texas and Florida and Georgia and Arizona, but it's also happening here in California and Los Angeles. Home prices are starting to go down. So if I told you that back in 2022, you'd have called me crazy, but the writing was on the wall if you knew how to read it. So I just wanted to share with you guys that, and that's very important. That's very important, especially for people who are first-time homeowners, right? It's super important. You could imagine you being an FHA buyer and only having to put down 3.5% in an area, let's say, for example, Tampa, Florida, right? You put down 3.5%, and then the following year, the value of your home had gone down by 7%. You're underwater. You're done. And that might be the biggest financial mistake you ever make in your life. So if you're not paying attention, you better, because it might be a terrible investment. You don't know. So you should really be thinking about that type of stuff, right? It's super important. All right, so let's go ahead and continue the video. Sorry.
Projections. The median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June.
Ridiculous projections, but okay.
In the labor market, the unemployment rate edged up to 4.3% in August, but remained.
So he's saying in the labor market, the unemployment rate edged up to 4.3. They utilized the Bureau of Labor Statistics, okay? 4.3. We just got a report from the Bureau of Labor Statistics, and they did a negative revision of the amount of jobs they added to the economy. They revised the jobs numbers by 900,000 jobs. I listened to this guy, Peter Schiff. He's a gold bug. He says, these guys got one job to do. One job. All they got to do is count jobs, and they can't even do that. And he's right. He's right. So if you think that this reading of 4.3% unemployment rate is accurate, you're out of your mind, dude. You're out of your mind. We already know in California it's higher than that. It's much higher. It's closer to 6%, I bet. And it's going to continue to go up. Mark my words.
Little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months.
29,000 jobs.
A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation.
This is ridiculous. Whenever they say wage growth outpaces inflation, that's the stupidest thing that I've ever heard. It's prices go up, okay? And they go up for a year, and then the employees, if they're good people or they do a good job, if they're lucky, they'll get a 3% cost of living wage increase. But they've already suffered. The prices have already gone up, and there's no shot that the wages that these companies are giving are outpacing the rate of inflation. That's just ridiculous, right? If you get a 3% cost of living wage increase and the inflation rate is 2.7%, if you believe those numbers, I mean, you cannot be that naive. You just can't. That's ridiculous. There's no shot. If there's one thing that we can guarantee in the future, nobody really knows what's going to happen with the housing market, the stock market, the world. Nobody really knows. If there's one thing that we do know, can basically say with 100% certainty in the future, the value of the dollar is going down. If you go to McDonald's today and you see two sandwiches, two for $4, in 10 years from now, it's going to be those two exact sandwiches for $10. Okay, that's one thing that we can guarantee. The value of the dollar is going down. Okay, so this inflation, wages outpacing the rate of inflation, you're out of your mind. In 10 years from now, there's going to be truck drivers making the exact same amount of money that I make today. And how you tell me how that works, outpacing the rate of inflation?
Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August.
So now he's talking about the CPI, right? The inflation rate. There's so many things that haven't really been yet gathered and taken into consideration when it comes to the CPI. I'll give you a great example. Here in Los Angeles, we just had these terrible fires, right, in the Pacific Palisades. Most of my viewers know because this is what I do. The vast majority of the content that I put out is talking about insurance companies and, you know, the rate of inflation and these areas, these houses completely getting wiped out, right? Insurance premiums haven't really gone up by a whole lot just yet, right? There aren't even houses to insure in these areas yet. But we know that State Farm got approved to raise their prices by 17%, and they're going to continue to raise their prices for the foreseeable future. But none of that data has actually been accumulated or acquired and put into the basket of goods, right, that the Federal Reserve uses in their index, right, their consumer price index. None of that information has been incorporated yet, and yet we still don't know what's going on with these tariffs, right? A lot of companies, from what I understand, are absorbing the hit initially of these tariffs, but they've come out and said, inevitably, whether it's Ford, General Motors, Toyota, when they buy parts from Canada, Mexico, and China, right now they're absorbing those costs, but inevitably those costs will be passed on to the consumer at some point in time. When? I don't know. It's anyone's guess, but it's going to happen. So sorry for rambling. Let's continue with the video, okay?
And that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%.
Okay, so now he's talking about the federal funds rate, and it's going to be getting lowered, right? So if you guys want to see where the federal funds rate, I don't know if I just showed you guys this, but just follow the 2-year. If you want to figure out where the federal funds rate is headed, follow the 2-year treasury. You can click right here and you can check this out. Follow the bond king too. Jeffrey Gunlock from Double Line Capital. If you're not listening to this guy, you're not doing yourself a favor. You really need to be paying attention to this guy. He knows what he's talking about.
And to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem.
An ongoing inflation problem. We've been above 2% for the past 5 years. We've had an ongoing inflation problem for 5 years now, bro. Come on. The problem is no longer inflation, right? The problem is the unemployment rate. And if you just take a look at the unemployment rate here, I mean, it's really at the bottom, right? I mean, historically speaking, the unemployment rate is still very low. But when you're on the floor, laying down on the ground, there's really only one way to go, and that's up. And usually, when you look at history, when the unemployment rate trends in the upward direction, it usually shortly thereafter goes vertical. And what you'll see, I believe, is over here in the future, in the next year or two or whenever, at some point in time, you're going to see another big, juicy, gray stripe there that represents a recession. And Donald Trump hates that, and he knows it. You know, he knows that what's going to happen. This is why they're declaring housing emergencies, and we need rates down now, right? He's trying to front run the recession. So, unfortunately, rates are going to be coming down for all the wrong reasons, and that's going to be because the unemployment rate, I believe, will be going up at some point in time in the near future. Just by looking at history, right? It tends to go vertical. From the bottom, vertical. From the bottom, vertical. It goes straight up, straight up, straight up. It's just, you know, just the way it is. It's the way that the economic cycle works. And just that's why I try to make these videos and inform myself as much as possible so I can potentially prepare myself for the worst possible outcome, right? A recessionary outcome. But I'm also doing my best to position myself and strategize, as you know. So if in the event of a recession and we do start to see prices go down in the real estate market or in other sectors of the economy, right? That could potentially be the opportunity of a lifetime, right? This is basic crisis investing 101. Like what happened in the Pacific Palisades. Most people, they don't have enough money to rebuild, and that's why you're seeing lots for sale everywhere, right? Insurance companies are giving them X, they need Y. It's that simple, right? And banks aren't lending money so freely anymore. All the people who were liquid, they're not liquid anymore, right? And it's just a mess, right? And now that we know that land values in the Pacific Palisades have gone down so substantially, you know, some people are saying that they've gone down up to as much as 40%. 40%, right? Could you imagine buying a lot for $1 million and then 8 months later, the value of the lot had gone down by 40%, let's just say, right? For that, the person who bought the lot prior to the fire, they're cooked, they're done. But for the potential investor, the young guy who's got $1 million, $2 million, $3 million, $10 million in the bank, it potentially offers the opportunity of a lifetime, right? And that's what investment is really all about. It's not buying at the top. It's buying at the bottom, man. Identifying the bottom. It's extremely hard to do, but in this world that we live in today, it's becoming much, much more easily identifiable because we have access to the internet. And Cameron, the uneducated truck driver who cheated his way through high school, has access to information from the Bond King, from Michael Pinto, from, you know, Jim Bianco, David Rosenberg, Danielle DiMartino Booth, right? These big guys with big brains and people who went to Stanford and Harvard and understand and learn the macro. Ray Dalio, right? One of the greatest investors ever, right? You have access to all of this information, and you'd be a fool not to listen to it. So, I don't know. I think this video is getting kind of long. Sorry about that. So I guess we'll go ahead and wrap this one up. I don't know how. Basically, the guy's cutting rates, and unemployment rate's going to be going up. All right, that's basically a summarization of what he just said. Okay, so I hope you guys enjoyed the video. I really did. I really do. And thank you to all of the people who continue to subscribe and support the channel and donate and comment and all that stuff. You know, I really do appreciate it. I don't convey that to you guys as much as I do. Most of the time, I'm strapped for time. You know, it's 8:30 at night right now, and I'm making this little video for you guys in an attempt to put out some content. But I've been up since 4 in the morning, man. My clock ticks. I'm a doer. I like to get out and be about and do stuff, man. So anyways, thank you again for everything, all of the love and support. And until next time, I'll talk to you guys later.